Okay, I guess we'll go ahead and get started, everyone. I want to thank everybody for coming to our second Business Banking and Beyond seminar. This is an attempt by our BOS team, the Business Services team, the Asset Management team, just to get all of our products and services out there in front of our customers, in front of our community. We certainly just want to thank you guys all for attending both in person today and virtually online. I do want to encourage all questions. We want to keep this somewhat informal, but certainly interactive. So if you think of a question, write it down. Those online, go ahead and type it in the chat box, and our team will let us know that you have a question, and we will address it as soon as we can. A couple of quick thank yous. I want to thank, first of all, our BOS marketing team. They really helped get people signed up today here in person. And then I also want to thank our partners with Local First Springfield. We've got several of our board members here today to attend. So thank you all again for coming. Today, my name is Justin Knoedler. I oversee our business services. What that means is I work closely with a lot of our commercial lenders. I work closely with our asset management team, kind of like the glue department that kind of brings all of our business products together. And so I will be getting us started today, but also today we've got Brian Brewer, who is our Senior Vice President of our asset management team. We've got Brad Leonard and Tim Wallin, both of our from our BOS insurance department. So we're all going to have our turn today going through our spiel, but BOS is doing great. You know, we are doing very well. We've grown tremendously over the last several years. We've expanded into 15 branches in Illinois and Missouri. And we've really tried to be that one-stop shop for all of our business customers. And just from your day-to-day cash management needs, from your the account level, but also what they also need, you know, for growth on their end, whether it be loans, insurance, and whatnot. So we're going to dive into a little bit of everything today. But again, I certainly encourage questions along the way. I'm going to touch on a lot of our services and our products, but not dive too deeply into them because I want to hit on what you guys want us to hit on today. So if you do have questions on a particular product or service, go ahead and reach out with a question, and I'll dive more into those as we go. But basically here, we're going to go through some of our products. So business banking products, simple as commercial checking accounts. We like to customize our checking accounts across the board. You know, you all have accounts at the personal level and the business level, but we have several different account types, and we try to customize what is going to specifically work for our customer. They all come with fees, or some of them don't have fees, but you know, we want to work with you across the board to customize an account for you. Secure and customized online access. We have what you call an e-banking product and an e-business product. We are in the process of merging those together to make it simpler for us and our customers, but we usually will put all of our business customers into our e-business platform. And it's just a more robust cash management software that allows you to do a lot of different things. ACH, bill pay, remote deposit capture, wire transfers, positive pay. You cannot do those through our more traditional online banking, but with our e-business you can. And so it's just a more robust cash management process. Other products that I've got listed up here today, merchant processing. We are with a processor called TSYS. They are a top 10 worldwide processor. We have the basic solutions when it comes to merchant processing, the old school terminals that you see a lot of people have that can accept, you know, the chip cards, the swipes, you know, the touchless, I guess, options that they have now, Apple Pay. But we can also integrate with a lot of POS systems. And so I know we've got customers here today that may be listening today that have restaurants and they have more robust POS systems that are specific to their industry. Sometimes we can integrate. And if we can integrate, we can typically save money on those fees. I know there's a lot of options out there now, but you know, we want it to make sense for our customers, but know that we do have options to take a look at, and we want to be able to offer it, especially if our business customers want to work directly with the Bank of Springfield and not have a third party involved outside the bank. Lockbox service. This is a very big service that a lot of insurance companies will use, medical office providers. This is an accounts receivable product. And again, I'm not going to dive into too much of the detail, but basically what it is it allows your receivables to come to the bank. We open your receivables, we scan everything in, we deposit the checks, and it's a more efficient way, less people touching money, a much more efficient way for businesses to get their money into the bank securely, and then, their accountants or the bookkeepers can reconcile their books virtually through online files as opposed to all the paper and the statements lying around. So it's a very good service. Corporate credit cards, another product that we offer. This is a product that sometimes it's hard for a business to get a corporate credit card. You got to go through the process of underwriting and whatnot. And if you're not working with a local provider, it's hard for you to get approved, especially at the limit that you want. So what our corporate credit card process allows is that, for example, if you've got a company and you've got 10 employees that need to go out and purchase gas or just purchase products on the company dime, what it is that they have these expense cards. We do require that those cards get paid off at the end of the month, but it's a very convenient and efficient product for our business customers to have. And we keep that all in-house. It's underwritten in-house. It's technically unsecured debt that we offer to our customers. But like I said, it's not you don't have the ability to carry that debt over from month to month. You need to pay it off at the end of the month. We are looking at other products to allow maybe a short-term credit process through that, but we haven't gotten to that point just yet. But next year, we've got obviously commercial loans. We are a commercial lending bank. We've got over $1 billion in loans right now out to our customers, and that's how the bank makes money. I mean, we're a community bank, we're a locally owned bank, but the nuts and bolts of our bank is driven by the commercial loans, but all these ancillary services also help generate the income. Now more than ever, especially in the times that we're seeing, rates are going up, so people maybe not want to take out loans. All these other products are allowing us to make income to support our employees and our operations. So different types of the loans here. Your general commercial loans are basically fixed. We do variable loans. We do operating lines of credit. That's pretty self-explanatory. Cash flow gets lower. Your receivables process is slow. We do have operating lines of credit that allow you to float that money for a short term. Those are typically year-to-year operating lines of credit. The other thing that happened actually during the pandemic, you see SBA loans here. We are a preferred lender for the Small Business Administration. It was huge during the pandemic with the PPP loans, which were offered by the SBA. And thank God we had it, because it was a lifesaver for a lot of our business customers. We were able to actually get some new business from the communities because the big banks were not helping the small business owners like the ones we have listening today and in the room today. So we were, it's very humbling, it's very satisfying to be able to offer these SBA loans. And what preferred lender means is we've got a couple of lenders on staff that have gone through the credentialing to be certified SBA lenders. So we can expedite that process. The SBA underwriting process can be more cumbersome. They do require a lot more underwriting, for lack of a better phrase. And so because we've got staff on our staff, we've got preferred lenders on staff, they can get it done much quicker, much more efficiently. Still have to request the things that we need, but because we're preferred, we're already kind of certified as a BOS lender to get it done much quicker than some. So next page here. The other thing that we like to do is we like to put employee banking packages together. So for our business customers that trust us with their bank accounts, we want to go out there and help their employees. So we work with the customer, our business customers, to put something together that they can then turn around and say, hey, here's a package that our bank has put together in order to bank you. And it can be anything from discounts on mortgage closing costs to consumer loans. We've got a personal bank account here that actually will allow you to get certain perks such as cell phone coverage insurance. It also allows for accidental death and dismemberment insurance. It's a pretty cool little product, so I'm happy to answer any more questions on that if anybody has any questions on that account. Yes, sir.
Something on that. The insurance department can do the same thing for any benefits, or if you guys have home and auto needs for that, we can help out with that. So that's a possibility for any of your employees. If they need that, we can assist with that as well.
Yeah, and that was Brad Leonard, for those that may not have been able to hear, because I am mic'd up at the moment. But Brad Leonard will be presenting shortly on some insurance products and whatnot. But they can also do similar things like at the account level that we were talking about. They can do the same thing. So group health benefits and retirement plans. We've got the full asset management. Brian Brewer will dive more into that. And then, group health, we've got a full BOS insurance agency, which includes your property insurance, your casualty, home, life, auto, commercial, cyber, professional liability, umbrella policies. So we do have a lot of that. And so, like I said at the beginning, BOS is committed to being that one-stop shop for all of your business banking needs, but it's not just banking, it goes into insurance and whatnot. And every once in a while, there is a product that we can't do. We do not do bookkeeping services. We don't do any tax services. And sometimes there are insurance products that maybe we don't have a great market for, but we do have customers that bank with us. We have partners that are even in this room right now that we can reach out to cross-sell those opportunities. So even though we may not be able to offer it in-house, we still have resources available to us to complete that one-stop shop. So with that, I'm going to wrap it up, my little segment here. Does anybody have any questions? Team back there, has anybody typed up any questions? Okay. Well, then it's my pleasure to introduce Brian Brewer, our Senior Vice President of our Asset Management team.
Thanks for the introduction, Justin. I appreciate it. And it's great to be here. This continuing series that we have with the business banking and beyond has been really successful. So we appreciate everybody joining us today. I'm just glad to be part of it. So in keeping with the informal nature of what we've been trying to do here, we're going to have a quick conversation about another pertinent topic associated with your business, and that's business risk. And joining me today is Brad Leonard. How you doing, Brad?
Doing all right.
Okay, Brad heads up our property and casualty division of the BOS Insurance Agency.
Feel free to heckle too, just to keep it informal.
Keep it live enough. We need an audience participation. But Brad does a great job with our customers. So we wanted to have a little bit of conversation about business risk. So Brad, with all the challenges facing business professionals, business owners today, risk mitigation just has to be one of the critical components of doing their job. So based on your experience here lately, can you give us some of the common areas of risk that you've seen and you've helped some of our business owners protect against?
Yeah, most definitely. Thank you, Brian. The biggest one that everyone's probably aware of, sees in the news all day, every day, is cyber risk. We had our first presentation about a quarter ago was on that. Everyone needs it. Unfortunately, it's probably the most undercovered space in the industry. So if you haven't had that looked at in probably 2 years, it probably has changed and the coverages are needed. Another thing that's really rapidly changing, as everyone probably knows, construction costs are skyrocketing. So what your value was on your buildings, your homes, your property is way more expensive now to replace that. So if you haven't looked at that in a few years, that's something to consider. Auto risk, severity has gone up greatly because everyone's distracted drivers, no one's really paying attention. So the severity of that has gone up greatly. But something we want to talk about today is your employee risk. So workers' compensation and employment practices liability.
Yeah, and great point. I mean, obviously, if you weren't here at our last series, Brad did a great job on cyber risk. We got a lot of great feedback from that. I think most people know property and auto risk, but you're absolutely right. Workman's comp, employee risk, employee practice liability are areas we don't focus on so much. So if you wouldn't mind, let's start with workman's compensation, Brad. Let's talk about some of the factors to consider there. If we could.
Yeah. So there's typically 4 types of areas you want to focus on when you're thinking about your workers' compensation. The first would be what type of work is being performed. And we'll kind of go on a little on that. What your projected annual payrolls are going to be, what your loss history has been, and then what your modification number is. And a lot of you may not even know what a modification number is, but we'll talk about what that is here in just a few slides.
Okay, and let's go ahead and start with the work performed. Obviously, there's a lot of different business owners here, different types of work. Why is that really something that we need to focus and key on, Brad?
Well, there's just so many different types of employees or types of risks out there. The example that I've got up here is just your typical concrete worker. As you can see, there's probably about 15 different classifications. You could be just your typical sidewalk, doing a little mom and pop sidewalk for someone. That's a low risk. You're not going to be doing anything too serious, not dealing with traffic. But that's typically like a $2 rate. On the other side, you could be a highway, construction guy at 60 miles per hour going past you all day, and that's a lot higher risk working on bridges. So it can range anywhere from $1 per 100 to $20 per 100. So you can see where having the proper classification is super duper important to that. Also, something to consider is I want to make sure that you guys see office manager. a lot of times you'll get bundled into one classification. The owner probably is the highest paid person, but they should be, or, say your, vice president of operations is getting bundled into that highest classification. So make sure that you're not getting charged that. We'll talk about how to avoid those downfalls in just a few slides. On the next slide, something you need to, look at this as is, have a conversation with your agent semi-annually to make sure that you are, not falling into these downfalls. If businesses change all the time, your appetite changes. There's a lot more industries that are coming up with different avenues. What you don't want to get hit with is, hey, we decided to go into a little riskier space and I didn't let my agent know it. And then the audit comes and they're going to say, wait, you got to pay 3 times of what we projected. That's going to be a hard pill to swallow when that time comes.
And just to interrupt.
Yeah.
I've seen Brad do that in meetings, and he stepped in to help some accounts that needed it a lot.
And I mean, it can devastate a business. I mean, one that he's talking about, we talked to an individual group where they thought they only were going to pay $20,000. When I figured out what was happening, and luckily we had 6 months before it happened, they were going to have to come up with around $150,000 at the end of the year because they were incorrectly classified. They weren't aware of what happened, and we needed to correct that at that time. So luckily, we were able to come in there, save the day, look like the hero, and weren't be able to fix it, but they were able to mentally prepare for that and financially prepare for that. The most important thing you guys can do is have that conversation with your agent. Then the next thing you can do is get it in writing from the underwriter. The agents are agents, me and Brewer back here, we're agents. We want to sell it, but I hope you trust us, but trust that underwriter because they're going to be the ones who have to explain, well, why did you classify it this way? And to take it one more step, talk to the auditor because that's the person who is basically the control of what at the end of the year, what you're going to be charged at. So if they see it's not the classification that the agent and the underwriter decide on, they're the final decision maker and you have to have that conversation. Maybe that's not the right market for you. You have that conversation and decide, all right, hey, we don't want to make this move because they're going to classify us in a different light.
First rule of thumb, always be nice to the auditors, right?
That's right.
I think we all know that. So the second item that you talked about, one of those factors was projected payroll. Obviously, payroll keeps going up. We have minimum wage changes, a lot of different things, qualified help. Why does payroll matter so much, Brad?
Well, I like to equate it to, it's like your taxes. You hope to have a good year. You hope you're going to grow. But if you are going to grow, you want to make sure that you're on top of those things. So let's say, beginning of the year, you think you're going to have $1 million in sales and your payroll is going to be $200,000. Well, it's just booming and you forget to tell them, but you have your budget at the beginning of the year, what you budgeted for. And that payroll that you put in there with that, with your agent, they're not aware of these changes. We're not, we can't guess it. So you have to have that constant communication with us and constantly keep on telling us, hey, I need to tweak it this much. I need to go a little higher, a little lower. What you don't want to do is give us more than we have to. Make sure that we're not overcharging you because you don't want to have us hold on to your money too long. We don't want to be your piggy bank. So you guys need to make sure that, hey, there's that constant communication. The best fix that's out there, not all carriers offer this, but something to consider is a pay-as-you-go option. So it's just like your taxes. If anyone does QuickBooks or Peachtree, any ADP, any type of payroll as you go, you can put another line item in there just for your workers' comp rate. Let's say you pay John Smith $1,000 and he's $1 per $100. So it would put in there for that $1,000 pay, you would get charged $10. They'd cut the check, they'd send it to the carrier. You're not out a lot of money. You don't have to pay that big upfront 25%, 50% upfront to pay the workers' comp rate. You just pay it as you go. And the nice thing about that is at the end of the year, the audit is basically, hey, here's the confirmation that everything we said was true. You're not out any money. It's a very painless audit. So I know a lot of people probably hate the tax audit. Work comp audits can be just as painful and sometimes just as severe. And then lastly, just have those conversations with the quarterly with your agents, making sure that, hey, if something changes, that we're aware of it. If you can't get that, pay as you go.
Great points, but I believe that audits performed well actually work to the owner's benefit. There's a lot of times where, catch a lot of different things up front, but a smooth audit really goes a long way, doesn't it?
Totally agree.
Absolutely. A couple other things that you mentioned, obviously, one of the factors, again, was loss history. Can you speak to that?
Yeah, no, loss history, that can really impact you more than just about anything. And it kind of segues into the next icon there. Frequency is worse than severity. What the insurance is there for is not for your piggy bank. What it's there for is when the stuff hits the fan and you really are going to be in financial straits. You need to make sure that you're basically, I have customers that think, hey, every single time I have a nick or a bruise, I'm going to send them to the doctor and we're just going to put that in. They don't realize what that's doing to that perception from the underwriters, because they understand there's going to be some bad losses, especially in the higher risk industries, but you cannot have it as a piggy bank. And every single person, doesn't understand the concepts of, hey, the longevity of this, you're going to basically have a lot more success with the carriers, and people are going to be a lot more attracted to you if you have less losses. So loss history is very important. The next segues into your NCCI mod rate. And a lot of people probably don't know what that is, but the best way I can equate that to anything is it's like your credit score. It's your history, your loss history compared to your peers. So let's say you're a contractor that does concrete. So if you have 0 losses, you're going to have a mod that hopefully says you're 0.8. What that equates to, they're going to give you your base rate, and then they're going to give you an additional 20% savings, because that's what your credit score, your mod rate tells you to do. Now, if you have a lot of claims and it gives you a bad mod, like let's say 1.5, you're going to have an increase of 50% on top of that rate that they're setting. And that rate is set by the state of Illinois. They cannot deviate from that. So that's something to keep in mind. That's where that severity can really affect you down the line, and make sure that you guys, if you have a good mod, and there's ways that we can fix those things. I'd like to have the conversation. I know we only have 15 minutes to have this conversation, but I'd love to have the conversation with people, how you can fix that. And there's other ways we can save you some money down the road, but I'm not going to get into those.
Okay. Well, like an inverse relation, credit score, you want to be high, but your mod should be low.
That is correct.
Keep that in mind. I'll write on my credit score. Well, the last item that you mentioned with employee risk, that was the employment practices liability insurance. What's that all about?
Well, it's really, came to light, unfortunately, since the pandemic. A lot of people were being laid off. And honestly, their natural reaction to say is, hey, you laid me off because I'm this age, or, I'm this race, or I'm this sexuality, or it's anything that you could be discriminated against, that they're going to say, that's why you didn't hire me, or that's why you fired me. And a lot of times there's not, legs to stand on, but the cost of your reputation cost is going to be severe, and the cost to defend it can be even more severe. So it's something that a lot of people say, well, you know what, I got a good lawyer friend, my cousin's a lawyer, I wouldn't need that. Well, trust me, it's going to cost a lot to defend that. So for the little cost that it would be to have this, it's worth having that just in those scenarios. Because most case scenarios, there's not going to be a claim where you're actually going to be at fault. But you want to be able to defend it. And I think the average right now, just for your, let's say a restaurant owner, it's going to be around $10,000 to $15,000 just to defend it in court. So just keep that in mind. And it's very inexpensive compared to what that cost is going to be for you down the road.
So pretty easy to get quotes on that?
It's very simple. It kind of goes hand in hand with workers' comp. So, if you get a workers' comp quote, it should be very easy for them just to take those same numbers and give you the employment practices liability quotes.
Okay, great information. I know there's a lot to unpack. 15 minutes can't do it justice with some of the employment risks that we have, but is there any questions that we have from the audience or maybe online?
Anyone online from home?
I got a question.
Yes, sir.
So you seem like it's pretty standard with these costs. per hundreds of dollars or whatever. Where does that number come from?
So that's the state of Illinois has a filing. So every year, every carrier, based on their ratios, their loss ratios and their loss history, they have to file with the state of Illinois Department of Insurance. And they say, okay, we will allow you to have a price at this much. So it's important to them to have low loss ratios so they can have a lower price. This is the one industry, workers' comp, that has actually gone down in price. So that's important to know. I really appreciate that question because a lot of people.
You're trying to make me look bad with
No,
health
no,
insurance
no.
on my next.
Well, everything's going up. Property's going up, auto's going up, cyber's going up. But workers' comp is going down because the pandemic has prevented a lot of injuries. And you got to keep in mind, you see a renewal, everything seems like it's going up. They'll just try to keep that workers' comp flat and say, hey, nice, we're being nice guys, but you don't realize they took away all those credits to keep that money because they don't want to be too severe on the other lines. So it's something to really consider because there's a lot of savings out there. I'd venture to say it's 15 to 20% discount the past 3 years from what the filed rates are going in the state of Illinois. So if you haven't looked at your work comp rate in a long time, just don't take it that, hey, they're giving us the best deal. Because I promise you, if you've not seen a new company in 2 to 3 years, it has gone down in those rates. Now, if you have bad loss ratios, all that can go out the door. It's dependent upon what your risk is. But yeah, I hope I know it was a long-winded answer, but yeah. Any other questions?
Throw in the other thing going down is my 401k. So I'm looking at that. Again, that's a different story, folks. And we have plenty of investment professionals that can help. But how do we go ahead and get a hold of you, Brad, more?
Yeah, as you can see, you can give me a call anytime, 217-241-6250, or you can send me an email. I think we'll have that in the chat as well for anyone at home. Just reach out to us. We'd love to have a consultation with you and just kind of review what you've got. We're not always going to guarantee that we're going to save you the best, but we want to make sure that as the industry has changed, that we make sure that you're covered the best, because that's what we're about. It's not about savings. It's about covering your business when disaster hits. So thank you all for your time.
Thanks for your expertise, Brad. And we'll keep the insurance conversation going now with another expert on the BOS Insurance Agency team, Tim Wallin.
Brad. Okay, yeah, can you hear me okay?
Yep.
This is awkward holding the mic. I'm gonna go ahead and start my timer here. So as they said, got to try to stick to the schedule here. So as they said, Tim Wallin, I'm with the BOS Insurance Agency. My primary focus is in the benefits realm. So that's group health, group life, dental. The department, as they've kind of covered, we've really grown in the last few years. Try not to overstate it, but we really basically do it all. So complex life insurance strategies. We have a full trust department and institutional investing. So I think we should be proud of that. So, but my specialty is kind of the benefits world. Anybody have health insurance in here? You don't have to raise your hand, but I'm making an attempt to make this relevant for everybody. So I'm assuming everybody either has health insurance. If you're a business owner, dealing with the expense of it, providing benefits. If you're an agent,
Mandated that we have to have insurance?
no, I mean,
I thought we had to.
In some ways you do. You don't want to incur a big expense, but so if you're an HR professional, this will be especially relevant to you. But anybody who has health insurance, the topic we're going to be discussing today is level-funded health insurance. Okay, so I wouldn't expect you to have heard that term if you weren't in the industry. But I'd like to introduce Jordan Schoenberg. Jordan, are you with us?
I am. Hello, everyone. Thanks for having me.
Is that a voice from above, or hopefully, can we get his face up there?
We are trying. We'll do our best.
The people online can probably see.
Yes, they
Okay.
can.
And I think what I have to say here today is going to be more interesting than my face. I mean, if you get to see that, that's an added bonus.
Yeah, Jordan, don't sell yourself short. You are devastatingly handsome. Yeah, so Jordan is with UnitedHealthcare, level funded. He used to be with All Savers. So again, I don't know if anybody's heard that brand. But obviously UnitedHealthcare is a household name. But you know, just being honest, Jordan, hopefully you don't mind this, but BOS, we represent, there's probably 4 locally competitive level funded carriers around here. We deal with probably 10 competitive carriers on the fully insured front, but there's really 4 competitive level funded carriers. Unfortunately for the others, UHC level funded is the best right now. That's got to stop. Good. So Jordan is the best in terms of pricing, back-end portal for just administration. And if he wasn't, we wouldn't have him here. That doesn't mean we're not going to quote other carriers, but I just want to give you access to kind of the best in the industry at the moment. So that's why Jordan's here. Quick little background on level funded health insurance. For those of you who have been either in the administration of health insurance for a while or have had health insurance for a long time, the previous system was if you're a business and you wanted to get health insurance, you'd have your employees fill out apps. Okay, so you know, for the people who've been employed for a while, you probably remember that. You get the application, you know, do you smoke? What are your health conditions? Then you submit it to the carrier and you get a final rate. With the Affordable Care Act, those logistics changed. So for smaller groups, they changed the system so that your rates were just based on demographics. So if you're, you know, male, female, age, you get a rate. Now, if you were an insurance company and I came to you and said, hey, I want you to insure me as a risk, chances are, you know, you don't know anything about me, you probably guess high. Is that logical? Everybody following that? Agree. So if you don't, where there's a lack of information, you kind of have to guess high to protect your bottom line. Everybody follow that? So what happened over time, you know, rates just kept going up after the Affordable Care Act for you know, a multitude of reasons, but one of them, they took away underwriting. And so what level funded plans have done is basically reintroduced the ability to underwrite risk, which if you're a healthy group, you want. And so that's a gross oversimplification, but level funded is the smartest way. If you've got a healthy group, it is the smartest way to get the best benefits at the lowest rate. And so if you have insurance through your employer, if you're a business owner, if you're an HR person, this is something you should know about. If you're an employee, ask your employer. So anyway, that's just a quick background history. Jordan, I didn't want to give you the burden of having to set that groundwork. What did I miss on, say, the history of level funded or the product in general?
You know, I thought that was pretty good. I'm going to expand a little bit. I like
That was
stats.
terrible. That's fine. Yeah, go ahead. That's good.
I like sports. I like stats, and I'm just going to kind of expand on the stats that you gave. So what I've seen, and I've been doing this since about 2007, I do represent the fully insured side, kind of the traditional ACA plans where there is no additional underwriting. So on a daily basis, I have line of sight to see what's happening on both the medically underwritten level funded side as well as the basically like book rated fully insured, where while it would be highly unprofessional and no one would ever do it, you could in theory go door to door with an age table for the fully insured rates and be somewhat accurate, you know, age table and a calculator. Nobody does that, but that's just an example of how really grossly oversimplified the pricing is on the traditional ACA plans. So using Tim's example, you have to kind of guess high because you need to, in law of large numbers, protect yourself from risk spikes. I would say, just generally speaking, that helps maybe 20-25% of groups out there that are on the higher claimant side. But what happens is everyone else subsidizes them. So the way you can get out of essentially having your healthier group subsidize the sicker groups in your area is with level funded. Now, is that going to be a fit for everyone? No. But if you haven't given it a look, you're not going to know till you find out. And with us, let's say you're in that 20-25% where it's not for you. we've got something for you on that end of the spectrum as well. So I think, you know, Tim and I and anyone else involved in the insurance business in this room can agree. You want to start with level funded, lead with that, see where it takes you, and then use the traditional ACA offering that came out back in 2011 as your fallback.
Yeah, good stuff, Jordan. So Jordan was kind enough, he prepared some slides. I did not give him any questions in advance, so he's flying blind. Just to respect your slide, let's start going through them. So, you know, with health insurance, there's a number of differentiating factors. So cost is always a big one. You know, there's all I don't know, we'll call them the frills that all carriers have, but most people don't utilize them. And then maybe the biggest one is the network. So locally, obviously, everybody's familiar with the disruption we've had with the clinic and Blue Cross. Jordan, if you don't mind, tell us a little about your network, say locally, regionally, and nationally. And anything else?
Yeah, certainly. We've got a few different provider networks. The most important thing that folks in the Springfield, Illinois area need to know is that any of them are going to work for you if you want to be able to go to the Springfield Clinic, you know, network of hospitals, doctors, etc. Even our narrow network offering does not narrow considerably around you, if at all. I've had a lot of conversations with employers and brokers in Springfield lately. As you might imagine, UnitedHealthcare has been a bit of a hot topic over the last 6 months or so. Done a lot of network checks just to confirm because, while I can tell you one thing, I also want to present the data to support what I'm saying. And not one time have I seen a doctor that is, for example, in our Choice and Choice Plus network, which is our largest locally and nationally, but not in core, where the core network is priced about 10% less. So I would use that as my starting off point. It does make sense on a employer by employer basis. Double check the network, make sure you know what it is you're moving forward on. But I have zero concerns.
Sorry,
Yeah, go ahead.
just to interrupt you. Basically, their network is great. Like if you're
Yeah, that's what I'm saying. I appreciate that simplification.
It's just true. Like they've got a national network, they've got a great local network. You know, one concern I hear from people sometimes is like if I'm out traveling and I happen to hit some pocket where you don't have a good network, how does UHC handle that in an emergency situation?
Yeah, and I'll give you an example back to the networks we see on the screen here. The Choice and Choice Plus, that's the largest we have locally and nationally versus core that narrows a bit. Let's say that you're traveling somewhere, you're, you know, middle of nowhere, North Dakota. And while you may know, may not know, we don't have a core network there. If you have a plan with the core network and you're physically traveling located somewhere outside of that network footprint, there is direct network reciprocity to the Choice and Choice Plus. So yeah, again, the main thing you need to know with us is that you're not going to find yourself in the United States, including Alaska, including Virgin Islands. We're not just talking continental United States, where you're somewhere where you won't be able to use your plan because of network inadequacy.
George, just to get you some more good talking points, you know, one of the concerns I get from employers sometimes with level fund is what is the degree of, say, health problem that would disqualify somebody from qualifying for level funded? And if there's a slide that helps you explain that, we can click ahead.
There's not, it's a great question. There's not a slide because it's a moving target on an employer by employer basis. The things that our underwriters are going to look at is the premium that comes in compared to the expected risk. And on smaller groups where I work the 2 to 50 market segment, so some are larger, some are smaller, it may be, you know, our dependents being covered. That'll move the needle on a premium perspective on a pretty small group. So I would say the best thing to do is let's get them through underwriting on our level funded product. And like we could speculate all day long, but we're not going to know really till we go through that process and just take it one step at a time. And, you know, maybe we find out at that point level funded is not the right plan, but then we have our traditional ACA plans as fallback. So I don't mean to give you a non-answer, but it's kind of the best I got for that one.
No, I think that's completely fair. In other words, you know, there's sometimes an employer will have somebody that they're out on a long-term, you know, illness where you kind of know it's not gonna work out. But generally speaking, if you've got an employer that's got like high blood pressure, cholesterol, stuff like that, like they're gonna qualify. And I'm not asking you to commit to that, but that's what I've observed in the market.
And I'd say you've gone through a good sample size of groups with us, Tim.
Yeah, so kind of the summary on that part would be, if you have an employer group that's relatively healthy, you know, in a small way that you can identify, if you've got 5 employees, you know if somebody's not showing up. If we're talking about a 30-person employer, the best bet is to go through the application process and just see if it's gonna help your business. We're talking, you know, ballpark, 30-50% savings. I see this all the time. One last, go ahead, Brandon.
Yeah, no, one thing that popped in my mind that I hear all the time when I discuss with my customers is they think on the health insurance side that all policies are the same. That, you know, it doesn't really matter. I mean,
That hurts my heart.
No, but that's the mentality.
Yeah.
Unluckily, we've seen how that's not true this past year with the Springfield Clinic situation. And it's something to consider that, you know, not everything is designed the same. It is kind of a custom as you go.
Oh,
You gotta have that conversation. And I mean, truly, I mean, you're getting what you're paying for. So just because it's a little higher, there's a reason probably for that. Is that true, Jordan?
Yeah, that was all fair comment.
Yeah, I would say so. I mean, and again, I mean, we offer 40 different plan designs on some different network chassis. So it's not like you're, you know, walking in and have a choice of just a couple. And so really what we try and do is work with, you know, broker partners like Tim and try and figure out, is it a certain benefit that we're looking to offer? Is it a certain budget we're trying to accommodate? And just make sure that what we're putting out there in front of you is a few choices narrowed down from the many that makes sense for you. And then one other thing, just while I'm still talking here. So we talked a little bit about underwriting. We talked a little bit about applications. We talked about really small groups. I just want to mention that for employers that have 10 or more enrolling employees and existing small group coverage, uh, at this time currently, and it's been the case for a couple of years now, we don't require you to go through that employee application project. And just to be frank, like it is a project versus what we can do for employers with 10 or more enrolling employees. You do need at least half your eligible employees to enroll, and existing group coverage is at that group size, we can underwrite based on data electronically. So that's somewhere where you can skip the project and still get the benefit of finding out where you fall from an underwriting perspective if you fall in that group size bucket.
One last comment, just to kind of, paint what the opportunity is in the market. My perception, Jordan, is, gosh, in this area, I'd say the uptake on this product is maybe 20%. I'd be curious what you're seeing. And the reason I'm saying is, the likelihood that your employer or your business has done this, I'm just trying to drive that point home. What would you say the percentage of businesses that are currently using level funded is in the market?
Not as high as it should be, that's for sure. I mean, I think the 20% may be accurate for who you're talking to, Tim, because I think you have a really good understanding. And I think that you're probably increasing that number. But if we take, Tim out of the equation here, maybe we're closer to 10 or 15%. So there's huge opportunity.
Yeah, and last thing, and then I'll be quiet. This is regular health insurance. It covers everything just the same. So it's, all that aspect is basically the same. Big difference is the ability to underwrite. And, it's just logical. Like if you don't know the risk, you're going to guess high. So Jordan, I think we hit the 15-minute. Is there any last closing words you'd like to share?
Yeah, I would say that what comes with the ability to underwrite is that, and really with, what is level funded is that it's technically on a self-funded chassis. And so what that means, it's a benefit for you as the employer, because that means if the account runs better than it's priced, then we'll send you a check back for a surplus refund, they call that. After you renew, it takes a few months. You do have to renew with us. When some employers hear self-funded, I know, maybe you hear some horror stories or get a little squeamish about it. The way that we have it set up is really to mirror what we did before the Affordable Care Act, where you're going to have predictable premiums. Once we have our final enrollment on the coverage start date, we've got our rates, they're locked for a year. So good claims, bad claims, it's going to work just like a renewal would have prior to the Affordable Care Act. Your rates will not adjust mid-year based on high or low claims. It's just looked at renewal time.
Yeah. So if you didn't catch that, what Jordan, if you have a good claim share, you get money back at the end of the year. And if you're on a fully insured chassis, who do you think, how are they paying for those big buildings, right? They're keeping, if you have a good performing year, they're keeping the margins.
Is there any penalty for a bad year? Let's say you don't perform, what could the result be as a business owner?
Great question. That's a reasonable concern. So, let's say you do this for a year and let's say you get somebody who has $1 million worth of claims, but the premium for the plan is only 30 grand. Your burden is only 30 grand. Now chances are they're going to give you a high renewal and you're going to get an increase. All you do is go back to what you're doing before. You just go back to the fully insured format. There's no underwriting and you can just keep on going paying high prices like you were before. But yeah.
So I had, and this is back before ACA, so I had a small business plan that had several younger women, and we had one year where there was something in the water and we had 4 pregnancies. And our rates went up from there and never came back down. How would you deal with something like that?
Yeah, so if you were insured on a level funded plan with that dynamic, loosely speaking, I don't think a pregnancy would wreck the plan. Or possible.
Well, yeah, I should say it was a small plan. So there were 10 employees plus some spouses on there. So you're looking at a huge number when it comes to that, yeah.
So we'll err on the side of, say, caution and say, let's say that the plan was wrecked in that circumstance. So that year you'd be fine, you go along paying the same premiums. At renewal, we would reevaluate the plan. And honestly, even if you either pivot back into the fully insured pool and you just pay the typical premium, or we would have those same, if they've had the babies, the cost has been incurred. So we would we might be done with Jordan, but we could go to a different level funded carrier who evaluates the risk because the pregnancies are no longer there.
Yeah, don't forget about me though. Don't forget about me after you move to that other carrier for a year. Oh, and one other comment, even in the example Tim gave, so bad claims year, who knows, maybe bad health year. It just happens sometimes, and it's something that's going to be an ongoing type thing, not a few pregnancies or a broken leg or something that's kind of a one and done sort of thing. So if you're on level funded plan with us, that happens, you get a big renewal increase on level funded, we're more than happy to keep you in the family and just shift you on over to the traditional ACA plan. So like for something like that, you wouldn't have to leave UnitedHealthcare, change networks, things like that. In the 4 babies example, you probably want to shop it and look at other carriers.
Thanks, Jordan.
Okay, well, back to me. I want to thank everybody. Again, we did have one question that came through online. And it basically was, how do we go about getting an all-inclusive package pulled together or a quote? And what we typically do is we get RFPs all the time. And so we will actually bring every department in the bank together to put together that RFP. We also will reach out to our customers on a yearly basis, sometimes every other year, because we don't want to bombard them every single year. But things are changing, things are evolving. And so what we do is we'll reach out to our customers and we'll do an efficiency review, what we call an efficiency review. And we will go through every single product and service that they're currently using, and perhaps some products and services that they're not using, but they could possibly benefit from. And so we will take, somebody from business services, perhaps a lender, we'll take somebody from the property and casualty division, we'll take a group health person, we'll take asset management, and we'll go on there with 4 or 5 people, and we will sit there with their team and just come up with a solution and pitch to them what we want. So it really is a one-stop shop opportunity with BOS. And we certainly welcome the opportunity to do those efficiency reviews and to meet with any of your teams that are here today. But once again, I want to thank our BOS marketing staff, Ashland and McAllister back there in the back for pulling all this together. Definitely want to thank the Local First Partnership, Local First Springfield, and for everything that they do for Bank of Springfield and for our community. So with that, we'll wrap it up. Until the next time, this is Business Banking and Beyond, the BOS. Thanks, everybody.